Today we're going to be looking at Chapter 21, Problem 6B. I've created an Excel spreadsheet for this problem, and what I did is I just copied the problem from Cengage so that I can show you how to work out the calculations for this problem. What we're going to be doing is we're going to be calculating the contribution margin, the break-even sales. You're going to be looking at a cost volume profit chart, margin of safety, and operating leverage. And the cost volume profit chart, margin of safety, and operating leverage may be new to you today, so I'll be introducing those concepts to you as we go through this problem. Bell-Main Company expects to maintain inventories at the end of 2000 Y7 as at the beginning of the year. The total production cost for the year is therefore assumed to be equal to the cost of goods sold. You can see I put this in bold so you would know that they're going to have you calculating cost of goods sold, and it's going to be equal to the total of all the production cost, which will be your materials, your labor, and your overhead. With this in mind, the various department heads were also asked to submit estimates of cost for their departments during the year. A summary report of these estimates is as follows. And so they have estimated the production cost for their departments, and they've also estimated the variable cost per unit sold. So the production costs are going to also be your cost of goods sold that we're going to be calculating, but they're broken down into materials, labor, and overhead. And you can see here that overhead is an estimated fixed cost. You'll remember that our fixed costs don't change with the production levels, or in this case, the level that we're going to be looking at or measuring is the level of the sales in units. But our materials, you can see they've given you a variable cost per unit. All of these are per unit cost here. And the variable cost per unit, of course, we have learned that it stays constant and will not change with the level of activity. However, the total variable cost would change, but not the variable cost per unit. So they've given you all the variable cost per units. They've estimated the amount of the production cost and the selling expenses, and they've also estimated the amount of administrative expenses. And so our fixed costs are going to be this column right here, and these fixed costs are shown as dollar amounts, and they've got them totaled here, so the total fixed cost is this amount. And then they've given you the per unit amounts for your variable cost, and they told you that it's based on per unit sold. So a part of the information that they also gave you in this problem was that they were expecting that 12,000 units would be sold. So 12,000 is going to be our expected selling as amount of units that we're selling this period. And we're going to sell those at a price of $240 a unit. So what I did is I just copied down the unit sales here and the unit selling price because we're going to be using these a lot in our calculations. The first thing they wanted us to do was to prepare an estimated income statement for 2000 Y7. And this is the heading for this income statement. And the income statement is going to be like any other income statement that you prepared. You're going to start with your revenue. And so what you have to do is determine how much revenue there would be for this company. And since they gave us the unit sales and they gave us the selling price, if you just multiply the two of these together, it will give you $2,880,000. Now, to find the cost of goods sold, you'll remember they told us that the cost of goods sold was made up of the production cost. So the production costs were your materials, your labor, and your overhead. Notice for materials, there is no fixed cost because materials are going to be a variable cost. The amount of materials will vary depending on the number of units that we've sold. In this case, the variable cost per unit for the direct materials is $50. We would need to take that $50 and multiply it by the number of units sold, and that will give us the direct materials portion of our cost of goods sold. So this $600,000 amount came from taking the expected sales in units, which was 12,000, and multiplying it by the variable cost per unit for the direct materials. And when you do that, that will give you a total variable cost for direct materials of 600,000. Your direct labor is calculated similarly because direct labor is a variable cost. Notice there was no estimated cost that they gave you, but the variable cost per unit was $30. So we need to multiply $30 times the number of units sold, and that will give us our variable cost for our direct labor, and the amount is $360. For our factory overhead is considered to be mixed cost. Some of the factory overhead costs are fixed. Some of them are variable. So what you have to do is you have to multiply your variable cost per unit times your number of sales, and then you need to add back to that the estimated fixed cost. And that'll give you the total amount of $422,000. Notice the formula up here is the number of sales times the variable cost per unit plus the fixed cost portion of this. So this is your variable cost plus fixed cost will give you the total cost of $422,000. Once you determine each individual part of the cost of goods sold, you're going to combine them all together and total them to find the cost of goods sold. And then we subtract the cost of goods sold from the sales, and that will give us our gross profit. The selling expenses are going to be done the same way that we did the production cost. We've got to look up top to see what's happened to our selling expenses. Notice your selling expenses are part fixed. This is your fixed cost column, and part variable. So we got to find our total variable cost for our sales and commissions, sales salaries and commissions. And to do that, we would take 4 and multiply it by the number of units sold, which was 12,000. 4 times 12,000 will give you your total variable cost portion of this expense. And then you're going to add it back to the fixed cost. So in other words, there's a formula here of B25 times G14. This is your G14 here. B25 is the number of sales in units times 4 plus 340,000. That will give you a total cost for your sales salary and commissions of 388,000. For your advertising, notice in your selling expenses, advertising, there's no variable cost portion of this. There's only fixed cost. So all of advertising is going to be a fixed cost of 116,000. Your travel is also considered to be just a fixed cost. You're in the fixed cost column here, and there's no variable portion of this. So 4,000 is the total fixed cost, which is also the total of the travel expense. For your miscellaneous selling expense, you had a variable cost of $1 per unit sold. So 1 times the number of units sold of 12,000 gives you total variable cost of 12,000. And then you got to add back to it the fixed cost, and that will give you 14,300. Then you're going to total up your selling expenses. And then we're going to go down and we're going to look at our administrative expenses, and we're going to do the same thing for those. Notice administrative expenses, office and officer salaries is just a fixed cost. So that 325,000 is what we put there. Our supplies that are administrative are both variable and fixed. So we got to find our variable cost first. To find your variable cost, you would take 4 and multiply it by the number of units that you were expecting to sell, which was 12,000. And so 4 times 12,000 would give you your variable cost portion. Then we're going to add back the fixed cost to that, and that'll give you a total of 54,000. For your administrative expenses, miscellaneous administrative expenses, they too were mixed cost. Got part variable here, so 1 times the number of units that we expect to sell, which was 12,000, gives you $12,000 as total variable cost. And then you got to add back your fixed cost portion to that to get the total of the miscellaneous and administrative expenses. And then you're going to add all your administrative expenses together. And then I'm going to combine my total selling expenses with my total administrative expenses. And that will give me the total expenses for this company, which would be subtracted from the gross profit. And that will leave you with the income from operations. In the second part of this problem, they want you to compute the contribution margin ratio. And it's based on the expected or the budgeted amounts that they came up with here. And to determine the contribution margin ratio, what you're going to do is you're going to take your contribution margin and divide it by sales. So down here, to determine the contribution margin, I've got to take my sales, which I just copied from up here where we figured out what our sales was. And then you're going to take your variable cost. Now, there's a couple of different ways you can get this variable cost, but the easiest way to get it is to go back to where they've given you the total variable cost here of $96. That's all of these individual department costs added together. The $96 times the 12,000 units sold will give you the total variable cost. Or you could go back and add your direct materials, your direct labor, your variable factory overhead, plus your variable sales salary and commission, plus your variable miscellaneous selling expenses, plus your variable supplies, plus your variable administrative expenses. All of these combined together also give you your total variable cost. But the easiest way is to take the total variable cost per unit and multiply it by the expected sales in units. And that's how I got this amount here. Once you know your variable cost, you subtract them from your sales, and that will give you your contribution margin in dollar amounts. But notice what they wanted here in part 2 was the contribution margin ratio. What this is the contribution margin. The contribution margin ratio is 60%, and it is found by taking your contribution margin and dividing it by your sales figure. So this contribution margin divided by the sales figure will give you 60%. I also took it a step further and showed you that this was the selling price per unit. And this was the total variable cost per unit that was given up above. If you subtract the two of these, it'll give you the contribution margin per unit. You could have also taken that 144 and divided it by 240, and it will also give you 60% as your contribution margin ratio. But this is your contribution margin ratio. This is what they wanted as an answer to part 2. But you had to go through some steps to be able to compute that. In the next part of this, they want you to determine the break-even sales in units and in dollars. So we're going to start with the break-even sales in units first. This is the formula for calculating it. You're going to take your fixed cost total and divide it by the unit contribution margin. You'll remember the unit contribution margin I found up here was $144. So your fixed cost divided by $144 is going to give you your break-even sales in units. So I need to know what my fixed costs are, and your fixed costs were given to you. So fixed cost up here, right here's your fixed cost. If you follow that column on down, you can see that your total fixed costs are $1,152,000. So $1,152,000 is divided by $144. That's your contribution margin per unit, and that will give you 8,000 units that you need to sell to break even. And so that's the first part of what they wanted you to determine. That's the break-even sales in units. They also wanted you to find the break-even sales in dollars. And this is the break-even sales in dollars formula that we've got here. It's still fixed cost, same fixed cost that we used before, but this time we're going to divide it by the contribution margin ratio. Remember, that was 60%. So your fixed cost divided by 60% will give you your break-even sales in dollars. The break-even sales in dollars is $1,920,000. So that was the answer to the second part of part 3. In part 4, they wanted you to construct a cost volume profit chart on your own sheet of paper. So you don't have to do this really, because all they're asking is what's the break-even sales? Well, we know the break-even sales is that because we just calculated it. So there's really no point in drawing the graph. It's the same thing. It's just a visual representation of the break-even point. And here I've copied a graph in here for you to see how they came up with the break-even point as a graph. But don't worry about making graphs. I'm not going to ask you to do that on the test. You can get the same thing by using the formula. I will ask you about the formula on the test, so you do need to know how to calculate break-even sales in dollars as well as break-even sales in units. And then in part 5, they're asking you what is the expected margin of safety in dollars and also as a percentage of sales. So they're asking you for 2 separate things again in this part. We haven't talked about margin of safety, so I feel like I need to tell you what margin safety is. The margin of safety is the amount of sales dollars that you could have lost and still broke even. There's a formula for margin of safety. It is your sales dollars less your break-even sales in dollars, and that will tell you what the margin of safety is. My sales is $2,880,000. We got that by multiplying the selling price times the number of units sold, and it's what we had expected to sell. So this was our expected sales for this period of time. This is also found on that income statement that we prepared up above. The break-even sales we just figured up. The break-even sales were $1,920,000, and that came from part 3 right here. So if you subtract your break-even sales from your sales, that'll give you the margin of safety in dollars. The margin of safety in dollars is the amount of dollars that you could have lost in sales and still broke even. The margin of safety can also be calculated as a percentage. And what I did to calculate the percentage is I took the margin of safety in dollars and I divided it by my sales figure. That would give you 33.33%. So we could lose 33.33% of our sales dollars and still break even. That's what the margin of safety is for us. And again, I've got it written out here as how you would calculate the margin of safety as a percentage. This is the formula for doing that. In part 6, they ask you to determine the operating leverage. And again, the operating leverage is a new term for you that we need to discuss. Operating leverage is a measurement that's used to show the relationship between a company's contribution margin and its income from operations. Operating leverage will measure the impact of changes in sales on income from operations. The operating leverage formula is calculated like this. To get operating leverage, we need to know what our contribution margin is, and we can divide that by our income from operations. And this contribution margin is in dollar amounts. So we would need to know what the contribution margin, sales figure less your variable cost. That's how you get the contribution margin. And then you would divide that by your income from operations. And I put a note here. I just wanted to make this clear to you. If the company could increase its sales by 10%, the income from operations would increase by 30% because of the operating leverage. Right here, we calculated the operating leverage for this company. We're going to take the contribution margin, which I found right here, 1,728,000, and we're going to divide it by the income from operations, which was in that income statement that we prepared earlier. So the contribution margin divided by the income from operations will give you what we call operating leverage. And the operating leverage for this company is 3. So basically we have 3 times the contribution margin as we do the income from operations. Notice the higher this is, the better off you're going to be, that when you increase your sales, that there will be a large increase in operating income. So I put this note to kind of prove this. If the company could increase their sales by 10%, this is what if analysis. What if we could increase our sales by 10%? What would it do to the income from operations? If we knew our operating leverage, we would multiply the operating leverage times the percent of increase in sales. And that would give us the percent of increase in our income from operations. And that increase in income from operations would be because of this 3 times the contribution margin as compared to the income from operations. But the operating leverage multiplied by the percent of increase in sales will give you an increase in income from operations. So management could use this for what if analysis. What if we were able to increase our sales? What would it do to the operating income? That's what this will give you, sort of a shortcut way for you to go through and determine what the operating income would be if we have an operating leverage of 3 times. So it'd be 3 times the percentage of change in sales will give you the percent of increase in income from operations. So that's all I want to talk to you about today, and we'll see you again next time. This is the last video that I'm going to do for this chapter. So we'll stop sharing this with you, and we'll see you next time. Bye-bye.